Have you ever wondered why managing debt seems like a daunting task for many people? It's a common conundrum, one that often stems from a lack of understanding about what debt really is and how it impacts our lives. From credit card bills to student loans, the world of debt can seem like a labyrinth of confusion. But here's the good news. Understanding and effectively managing debt is possible. Debt management doesn't have to be a nightmare. It's all about knowing the right steps to take. The first step to effectively manage your debt is to understand what debt truly is. So let's dive right in. Debt, at its core, is money that you owe. It's an obligation, a commitment to repay the amount you have borrowed, often with interest. Now, there's a common misconception that all debt is bad. That's not entirely accurate. Debt can be categorized into two types: good debt and bad debt. Good debt is an investment that will grow in value or generate long-term income. Think of student loans or mortgages. These are typically associated with lower interest rates and can potentially improve your financial health in the long run. On the other hand, bad debt involves borrowing money to purchase depreciating assets, like that shiny new car or the latest smartphone. These purchases might give you instant gratification, but they won't contribute to your financial growth. Debt can significantly influence your personal finance. It can affect your credit score, which in turn impacts your ability to borrow money in the future. It can also eat into your income, leaving you with less money for savings or investments. However, debt is not a financial death sentence. It's a part of many people's financial journeys. The key is to manage it effectively. And to do that, you need to understand it. You need to know how much you owe, to whom, and at what interest rate. Understanding your debt is the foundation of effective debt management. By fully comprehending what you owe, you can create a roadmap to financial freedom. So, let's get started on understanding and managing your debt. Now that we understand what debt is, it's time to take an inventory of all our debts. Imagine walking into a warehouse, one filled with boxes. Each box represents a different debt. There are boxes for student loans, credit cards, car loans, and maybe even a mortgage. Now imagine trying to clean up this warehouse without knowing what's inside each box. It would be chaotic, right? This is why knowing exactly how much debt you have is crucial. It's about opening those boxes and understanding what's inside. Think about it. If you don't know the total amount you owe, how can you plan to pay it off? It's like trying to reach a destination without knowing where you're starting from. It's important not just to know the total amount of your debt, but also the interest rates and payment terms associated with each one. This information will help you determine which debts to prioritize in your repayment plan. For example, let's say you have two loans. One has a lower balance but a higher interest rate. The other, a higher balance but a lower interest rate. In this case, it might be wiser to focus on paying off the loan with the higher interest rate first to minimize the amount of interest you'll pay over time. But how do you keep track of all this information, you ask? Well, there are many tools available to help you. There are debt calculators that can help you understand how long it will take to pay off your debt based on different payment amounts. There are also tracking tools that can help you organize your debts, keep track of payment dates, and monitor your progress. Remember, debt is not just a number. It's a complex puzzle with many pieces. And to solve it, you must first understand all the pieces you're working with. So go ahead, open those boxes. Take a good look at what's inside. You might be surprised by what you find. Knowledge is power. Knowing the full scope of your debt is the first step in gaining control over it. Scene script. Armed with the knowledge of your total debt, the next step is to create a budget. Creating a budget is akin to drawing a financial map. It helps you understand where your money is going and how you can direct it more efficiently. More importantly, it's a crucial tool in managing and reducing your debt. The idea of creating a budget may seem daunting, but it's really about understanding three key elements: your income, your expenses, and your debt payments. First, let's talk about income. This is the money you earn. It could be from your job, from a side hustle, or even from a passive income stream. It's important to know exactly how much money you have coming in each month. Next, we have expenses. These are the things you spend money on, from essentials like rent and groceries to discretionary spending like entertainment and dining out. To track your expenses, keep a record of everything you spend money on for a month. You'll be surprised at where your money is going. Finally, we have debt payments. These are the regular payments you're making to reduce your debt. This could be credit card payments, student loan payments, or any other form of debt you owe. Now, the magic of a budget comes from balancing these three elements. Your goal is to ensure that your income covers your expenses and your debt payments, with hopefully a little left over for savings. If your expenses and debt payments exceed your income, you'll need to make some adjustments. This could mean cutting back on discretionary spending, finding ways to increase your income, or both. Remember, a budget is not a constraint. It's a tool that gives you control over your finances and helps you make informed decisions. It's about planning and prioritizing, knowing when to spend and when to save. And most importantly, it's about making sure you have enough to cover your debt payments and inch closer to being debt-free. A well-planned budget is your roadmap to financial freedom. With a budget in place, it's time to strategize on how to reduce your debt. One common strategy is the debt snowball method. Imagine a snowball rolling down a hill, picking up more snow and getting larger as it goes. That's the principle behind this method. Start by paying off your smallest debt first while maintaining minimum payments on the rest. Once that's paid off, you roll what you were paying on that debt into the next smallest debt, and so on. The benefit of this method is the psychological boost you get from paying off a debt completely. It can be a real motivator. However, it may not be the most cost-effective strategy as it doesn't take into account the interest rates. So if you're more concerned about the overall cost, you may want to consider the debt avalanche method. This is like an avalanche where you start at the top with the highest interest rate debt and work your way down. You make minimum payments on all your debts, but you put any extra money towards the debt with the highest interest rate. Once that's paid off, you move to the next highest interest rate, and so on. The advantage here is that you'll save more money over time. But the downside is that it may take longer to pay off each individual debt, which can be discouraging for some. Another option is debt consolidation. This involves taking out a new loan to pay off your existing debts. This can be advantageous as you'll only have one payment to manage and the interest rate may be lower. However, it's important to be aware of the potential pitfalls. It might be tempting to run up new debt on your now paid-off credit cards, and you may end up paying more in the long run if the consolidation loan has a longer term. Each of these strategies has its pros and cons, so it's crucial to consider your personal circumstances, your mindset, and your financial goals when choosing a strategy. Choosing the right strategy can accelerate your journey towards a debt-free life. Finally, once you've managed to reduce your debt, it's crucial to stay debt-free. It's like reaching the peak of a mountain after a strenuous climb. The view is breathtaking, the air is fresh, but the challenge is to stay at the top and not slide back down into the valley of debt. Let's delve into some habits that can help maintain this debt-free lifestyle. First and foremost, living within your means is essential. This doesn't mean you have to deprive yourself of everything you enjoy. It's about making smart decisions and prioritizing needs over wants. Think of it as a diet for your wallet. It's about balance, not deprivation. Next, let's talk about saving for emergencies. Life is unpredictable, and unexpected expenses can pop up at any time. By setting aside funds specifically for these unforeseen events, you can avoid falling back into debt. It's like having a safety net, ready to catch you when life throws a curveball. Continual budgeting is another key habit. Just as a ship needs a compass to stay on course, you need a budget to guide your financial decisions. Regularly updating and reviewing your budget can help you stay on track and catch any potential issues before they become problems. It's like having a financial GPS, always guiding you towards your goals. But above all, maintaining a debt-free lifestyle requires financial discipline. It's about making conscious choices every day. It's about being aware of where your money is going and making sure it aligns with your goals. It's like being a financial athlete, constantly training and improving to stay in top shape. In conclusion, staying debt-free is not just about paying off your debts, but also about cultivating habits that prevent you from falling back into debt. It's about being proactive rather than reactive, and making smart decisions that support your financial health. Remember, staying debt-free is a lifestyle, not a one-time event. It's a journey that requires commitment and discipline, but the rewards are well worth the effort. So, take the reins of your financial future and steer towards a debt-free life.